It's Wednesday, February 4th, 2026. Usually when we sit down to crack open a topic like the insurance industry, there's a certain mental preparation involved.
Oh, yeah. You brace yourself.
You do. You steel yourself for a conversation about, actuarial tables, risk mitigation, stability, safety, and, let's be honest, a pretty healthy dose of, well, boredom.
It's not usually the stuff that gets the heart racing, no. It's kind of the broccoli of the financial world. Necessary, good for you.
But rarely exciting.
Yeah,
literally.
exactly. But today, we are looking at numbers that, frankly, just defy that boring insurer stereotype.
They really do.
We're looking at a legacy giant that isn't just surviving the modern economy. They're essentially printing money from every single corner of the globe. This isn't just a good quarter.
No, this is an absolute juggernaut, and it's a standout moment. We're looking at a company that just posted its best year in history, firing on cylinders that I think most people didn't even know they had under the hood. So we are diving deep into Chubb Limited, ticker symbol CB, and their Q4 and full year 2025 earnings report. And look, the mission today is specific. We're not just going to read off a balance sheet. Anyone can do that.
Right.
We want to understand the mechanics. How does a massive, old-school insurer manage to act like a high-growth tech stock while navigating everything from California wildfires to the AI infrastructure boom?
That is the multi-billion-dollar question, isn't it? It's about risk and reward on a global scale. We've come through CEO Evan Greenberg's earnings call, the detailed financial supplements, and, all the market analysis from the last 24 hours to piece this puzzle together.
Okay, so let's not bury the lead. We have to start with what the analysts are calling the triple record.
It's the headline that grabbed everyone's attention. I mean, in the fourth quarter of 2025 alone, Chubb's core operating income was nearly $3 billion.
$3 billion and a quarter.
Specifically, $7.52 per share. That's up roughly 22% from the same time last year.
And for the full year?
Just shy of $10 billion, $24.79 per share. But the raw number, that isn't really what makes this a deep dive topic. It's the composition of that number.
Okay.
To understand Chubb, you have to realize they have, three distinct engines running at the same time.
Right. Let's break those down.
First, you've got P&C underwriting, property, and casualty.
Yeah.
That's the actual business of insuring things, taking in premiums, paying claims.
The core business.
The core business. Second, you have investment income, the money they make on the massive pile of assets they hold. And third, you have life insurance.
And usually in this industry, it's a bit of a balancing act, right? If your investments are way up, it might be because the economy is overheating, which could mean inflation is hurting your claims costs.
Precisely. Or if underwriting is great, maybe interest rates are low, so your investment income suffers. It's very rare for the stars to align perfectly.
One engine is roaring, another one's sputtering.
Exactly. It's just the nature of the beast. But in 2025, all three hit records simultaneously. P&C underwriting income was $6.5 billion, investment income was nearly $7 billion, and life insurance, which is often the quiet sibling in the Chubb family.
One nobody talks about.
Yeah, that brought in $1.2 billion.
It's the hat trick.
It is. And to really understand why this matters to you, the listener, we have to strip away the big dollar signs and look at the efficiency metrics, specifically the combined ratio.
This is always the first thing I look for. It's the lie detector test for an insurer.
It is the gold standard. For those who aren't staring at insurance spreadsheets all day, it's pretty simple math. It measures how much money goes out in claims and expenses for every dollar of premium that comes in.
So if it's 100%,
Yeah.
You're breaking even on the actual insurance.
You're breaking even. Exactly. If I pay Chubb $1 and they spend $1 on claims and keeping the lights on, they're at 100. They're relying totally on investing my dollar to make any profit.
And anything over 100, they're losing money on the policy itself.
Right. Anything below 100 is pure underwriting profit. In Q4, Chubb hit a record low of 81.2%.
81.2. So for every dollar they take in, they keep roughly 19 cents of pure profit before they even think about investing the money.
Exactly. In the insurance world, an 81.2% combined ratio it's almost unheard of for a company this size. It's like a baseball player batting .400. It's just an enormous margin.
So what makes it so impressive? I mean, besides the number itself.
Well, and this is key. This wasn't just a lucky year for weather.
That was my next question. Did we just have a year with no hurricanes, no floods? Did Mother Nature take a vacation?
Far from it. We tend to think, oh, record profits must have been blue skies. Not true. They absorbed $365 million in catastrophe losses, just in Q4.
Just in one quarter.
For the full year, it was $2.9 billion in catastrophe losses.
Nearly $3 billion in losses, and they still broke records.
That $2.9 billion was largely driven by those severe California wildfires back in Q1. But the underlying business is so efficient, the pricing so accurate, the expense management so tight, that they could write a check for almost $3 billion in disaster payouts and still post the best year in their history.
That just speaks to an incredible level of resilience.
Yeah.
But I want to zoom in on something a little weird in the Q4 numbers.
Yeah.
I was looking through the segment breakdown, and there was one specific driver that really juiced the stats.
You saw the ag numbers.
I did. Agriculture. This feels like such a niche corner of the market, but the numbers were huge.
It is niche, but Chubb is actually the #1 crop insurer in America. And in Q4, premiums in their agriculture division were up over 45%.
45%. That's massive. Did every farmer in America suddenly decide to double insure their corn? What happened?
No, and this is a fascinating lesson in how government-backed insurance works. It wasn't about selling more policies. It was largely due to a profit-sharing formula with the government.
Okay, let's unpack that. How does that work?
So most crop insurance in the U.S. is part of a federal program. Private companies like Chubb, they service the policies, but the government reinsures a lot of the risk.
Okay.
And the contracts are structured so that if it's a very profitable crop year, meaning fewer droughts, better yields than expected, the private insurers, like Chubb, get a bigger slice of the profit pie at the end of the year.
So it's almost like a performance bonus for a good harvest season.
Essentially, yes, it was a benign year for crops. Losses were lower than the baseline, so the formula kicked in, and Chubb recognized a massive amount of premium and profit in Q4.
It's a great example of how a specific line can cause these massive quarterly swings.
It is. But it also feels a bit like a one-off, If next year is a drought, you're
Now, 45% growth vanishes instantly.
It does, and Chubb was transparent about that. But here's the kicker. Even if you strip that outtake, the farming, completely off the table, their global P&C combined ratio was still 80.9%.
So the bumper crop was just icing on the cake. The cake itself was still solid.
Exactly. They weren't leaning on the cornfields to save the quarter. The core engines were running hot regardless.
Now, let's shift gears. We often think of Chubb as this very American, very corporate entity, insuring skyscrapers in New York, big fleets of trucks.
Maybe the CEO's yacht in the Hamptons.
Exactly.
Yeah.
But there's a hidden growth engine here that I think a lot of people miss, maybe because they don't live in the markets where it's happening.
The international consumer business.
Right. This isn't selling liability insurance to a Fortune 500 company. This is selling to everyday people, but not in Ohio or Florida. We're talking Brazil, Vietnam, Thailand.
This is a huge part of their strategy that really flies under the radar for U.S. investors. Their overseas general division had a fantastic quarter. But if you look under the hood, the consumer side is it's booming. We're talking nearly 19% growth in Q4.
And where specifically is that demand coming from?
Latin America is the standout star right now, up nearly 15%. And Asia grew 13%, driven by a massive 25% jump in consumer lines.
But Chubb doesn't have, like, thousands of little storefronts in Sao Paulo or Bangkok, right? How are they reaching these customers?
No, they aren't building brick-and-mortar branches. This is the real aha moment. They have become a master of embedded insurance.
Embedded insurance. I love this concept.
Think about your own digital life. You're on a banking app, maybe applying for a card. You see a button to insure your phone or get a small travel insurance policy. You click it, the money comes out of your account, and you're covered.
And Chubb is the invisible engine in the background.
Exactly. They have these massive partnerships. In Brazil, they partner with Nubank, which is one of the largest digital banks in the world. In Chile, they work with Banco de Chile. They are integrating their product directly into the platforms where people already spend their time.
That changes the entire economics of it. You don't have to pay an agent a commission. You don't have to run a TV commercial. The customer is already there.
It's high volume, steady margin business. It's sticky. Once you click that button, you rarely cancel. And the acquisition costs are incredibly low. It's a totally different beast than negotiating a multi-million-dollar contract over 3 months.
It's just brilliant diversification.
Yeah.
You've got crop insurance in Kansas, relying on weather, and you've got a digital banking customer in Brazil buying travel insurance on their phone.
And that's what creates the moat. If the U.S. economy slows, maybe the Asian consumer picks up. If weather is bad, maybe the investment income saves you. Which, speaking of which, we have to talk about that other side of the balance sheet.
The investment beast.
We've talked about how they make money from premiums. Now we have to talk about the float.
The classic Warren Buffett concept.
It is. Insurance companies hold your money before they have to pay it out in claims. And Chubb is sitting on a mountain of assets, over $169 billion.
$169 billion. That's larger than the GDP in many countries. And interest rates are still relatively healthy.
Which is a gold mine for them. Their fixed income portfolio yield, so the interest rate they're earning on their bonds, is sitting at 5.1%.
So what does 5.1% on that mountain of cash actually look like on the bottom line?
In Q4 alone, their adjusted net investment income was a record $1.81 billion. They're collecting nearly $2 billion a quarter just for having money. And here's the key. Because their cash flow from underwriting is so strong.
Because they're making that 19 cents on the dollar.
Exactly. They don't have to dip into the principal. They don't have to sell the bonds to pay the claims. They pay claims out of new premiums coming in. So the investment pile just sits there, compounding, growing bigger.
It creates a floor for their earnings.
An incredibly stable one. Management expects that income to stay right in that $1.8 billion range for the first quarter of 2026.
So, okay, we have the engines firing. Underwriting is efficient, international consumer is clicking by, the investment portfolio is yielding 5%. But let's play devil's advocate. It can't all be sunshine and roses.
It never is. There are always headwinds.
I want to talk about the pricing environment. I feel like my personal insurance bill goes up every year, but I'm hearing that for big companies, rates are actually falling.
It's a mixed bag, and this is where you really see the nuance. Evan Greenberg was very specific about this on the call. The market is in transition.
What does that mean for the customer?
It depends what you're buying. In commercial property insuring buildings, factories rates for large accounts are actually falling, down about 13.5% in the quarter.
That's a huge drop. So big corporation is getting a discount on property insurance compared to last year?
Likely, yes. And that's because the property market has been very profitable, so more capital has flooded in. Everyone wants that business, so they're cutting prices to get it.
But I'm going to guess casualty and liability is a different story.
Completely different. Casualty, which covers you if you get sued, is seeing rates rise. They're up about 8.5%.
So why the split? Cheaper to insure a building? More expensive to insure against a lawsuit?
2 words. Social inflation.
Okay, we hear this term a lot. Let's unpack social inflation for the listener who thinks inflation just means eggs cost more.
Evan Greenberg gets really passionate about this. Social inflation refers to the rising cost of claims from things like increased litigation, broader definitions of liability, and, crucially, massive jury awards.
The so-called nuclear verdicts.
Exactly. If a jury awards $100 million for an accident that used to result in a $5 million settlement, that is social inflation. Greenberg noted that litigation costs are rising at roughly 7 to 9% a year.
Which is wildly higher than standard CPI inflation.
It's multiples higher. And Greenberg's argument is fascinating. He pushes back hard against politicians who blame insurers for high premiums. He essentially says, don't shoot the messenger.
Because the insurer is just the intermediary.
Right. He views the insurance company as a pass-through. If society, through its courts and juries, decides accidents should cost more, then society has to pay higher premiums to cover those costs. He's explicitly calling out the legal system as the culprit.
It's a stark warning. If we want a highly litigious society, the price of admission is higher insurance premiums for everyone.
Exactly. And that creates a floor on how much rates can really drop in those sectors. You can't cut prices on liability insurance if the cost of getting sued is going up 9% a year. It would be financial suicide.
Speaking of future risks, let's pivot. We can't do a deep dive in 2026 without talking about AI.
Had to get there eventually.
But with Chubb, this isn't just about, oh, we use AI to write marketing emails. This is a physical play. It's about infrastructure.
Correct. Chubb is a major player in ensuring the AI boom. I mean, think about what AI actually is. It's not just code in the cloud. It is massive physical data centers.
Which need to be built.
And that's where Chubb steps in. They write the builder's risk insurance for construction, then the property insurance for the finished building, the liability insurance for the operations, and, crucially, they insure the energy and utility companies that power them.
It's the ultimate pick and shovel play. They aren't betting on which AI chatbot wins. They're betting on the fact that the buildings have to exist.
It's the classic infrastructure play. But, and this is classic Evan Greenberg, He was very realistic on the call. He didn't just hype it up.
What was the note of caution?
He basically asked the room how much of this actually gets built.
It's a fair question. We see announcements every day.
Greenberg pointed out the headwinds. Energy availability is the big one. You can't build a data center if the grid can't power it. Then you have labor shortages and supply chains. Can you even get the chips?
So he's betting on the trend, but he's not assuming every press release turns into a premium check.
Exactly. He sees it as a second act opportunity. He's disciplined. He's not going to chase every project if the risk profile doesn't make sense.
That discipline seems to be the theme of the whole report.
It is, whether it's not chasing property market share at low prices or not overhyping the AI boom.
Now, are they using AI internally or just ensuring it?
They are. They mentioned 9 or 10 discrete projects aimed at digital transformation. But again, the goal isn't flashy features. The goal is cutting the expense ratio.
Making that 81.2% combined ratio even lower.
Exactly. Using AI to process claims faster or to spot fraud better. It's all about operational efficiency.
Okay, let's zoom out and synthesize this. We've got a record year. $10 billion in operating income. A triple threat of underwriting, investment, and life insurance all firing. A massive boom in international consumer business. And a cautious but active role in the AI infrastructure build-out.
It really was a masterclass quarter. They balanced a softening property market with strong investment returns and that massive international growth.
For the learner listening to this, what is the big takeaway? Why should they care about Chubb, aside from the big numbers?
I think it's a lesson in the power of being boring but broad. Chubb isn't a tech startup trying to disrupt the world, but by being diversified, by being in Kansas cornfields, Brazilian smartphones, and New York boardrooms all at once, they can utilize all these different global trends to generate massive value.
They're essentially a proxy for the global economy's risk management.
And they're managing that risk profitably. It shows you don't need to be the one inventing the new technology to make money from it. You just need to be the one keeping it safe.
Before we sign off, I want to leave our listeners with a thought based on Greenberg's comments about litigation and risk. Something that really stuck with me.
The expensive risk question.
Right. As we enter this era where AI demands more power, straining our grids, and litigation is driving up liability costs at 9% a year, we're entering an era of expensive risk. Insurance premiums are just the price tag on that risk.
And the question is, if those premiums are the messenger telling us the world is getting riskier and more litigious, are we ready to listen to that message? Or will we just keep trying to shoot the messenger?
Something to think about next time you look at your renewal notice. That is a wrap on our deep dive into Chubb's 2025 record-breaking year.
Thanks for listening.
We'll catch you on the next deep dive.